Welcome back. Today we are going to explain another incredibly useful metrics in financial analysis. We are going to learn debt to assets ratio. So what does it do? Companies borrow money to grow, and the debt to assets ratio shows the proportion of a company's assets that are financed by this debt. It's a measure of leverage, similar to the debt to equity ratio. Why does it matter? This ratio helps us understand how risky it is to invest in a company. More debt can mean higher returns, but can also mean higher risk. Let's look at the formula. Debt to assets ratio equals total debt divided by total assets. So in the most basic example, if our total debt is 200 and our assets are 100, our debt to assets is 200 divided by 100 and equals to 2. So where do I find this data? Both debt and assets are found on the balance sheet. Let's look at a more detailed example. Here is a balance sheet of an ABC company. Total liabilities are $35,000. Total assets are $95,000. And debt to assets is $35,000 divided by $95,000 is 0.37. Which means that for every dollar of assets, the company has 37 cents of debt. Lastly, let's discuss what are considered to be healthy and unhealthy levels of the debt to assets ratio. While it depends on the industry and stage of growth of the company, in general the ratio below 0.5 is considered to be very healthy. 0.5 to 1.5 acceptable for most industries, meaning that a company gets $1 of sales for every dollar of debt. Anything above 1 is considered to be risky. Thank you for watching. If you want to learn more financial ratios, like and subscribe.